Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Apologies for anyone who tuned in yesterday, Monday on normal time, midday London time, that is. We had a few technical issues, so do apologize for that, but hopefully you can catch up with this recording on YouTube at some point. Just showing you the disclaimer, which I need to show you before we get started. We'll follow the normal format, so we'll just check out how markets are trading currently. We'll look at earnings and Walmart and a couple of the miners. And then we'll just have a few thoughts on equities, obviously, with this volatility that we've seen recently. We'll then get into last week's main events, some big top tier US economic data, non-farm payrolls, of course, and the inflation report. And then we'll get into this week's main data points. We have a data dump from the UK, and we've had job numbers already this morning. And we'll also look at the CPI data out of the UK and then other bits of data as well. This week we have PMIs on Friday, global surveys basically of business activity, and we have a central bank meeting, actually the RBNZ. So we'll briefly look at that, and as well the Fed minutes if we get time, along with all the associated currency pairs. I should say, if you do have any questions, please do ask them along the way, and we'll be more than happy to answer those as best we can. Currently, markets, well, APAC stocks, they traded mixed, really amid quite thin conditions, really. We've got the Lunar New Year just kicked off in China, of course. So a few markets there closed. And of course, we had a US holiday yesterday for President's Day as well. So thinner liquidity really in Asia. Not many new catalysts, although the Nikkei 225, that did retreat shortly after the open with SoftBank and heavy industry stocks leading the declines, really as the post sort of election euphoria petered out really following actually underwhelming GDP data that we got yesterday. Just on that, the quarterly pace of 0.1% missed the 0.4% bar and came after a downwardly revised Q3, negative 0.7 from negative 0.6. If you looked at the details there, they were slightly less worrisome, really. Weak public investments and notoriously volatile private inventories being the main culprits. And of course, PM Takaichi's strong mandate and election pledges as well certainly suggest government spending is about to shift into a higher gear. Dollar yen has pulled back with pressure seen as risk sentiment in Japan deteriorated shortly after the open. Um, I'm just checking dollar yen now, actually. But yen was underperforming yesterday after that GDP data, certainly. We've had President Trump said he will be involved in the US-Iran nuclear talks indirectly, and that Iran wants to make a deal, while he also stated actually that Iran are bad negotiators and he hopes they will be more reasonable in talks. We have had headlines that Iran have or embarked on military exercises, I think, in the Straits of Hormuz, which obviously carries a lot of global oil supplies through it. So nothing major on the oil front there. Oil slightly up, Brent crude. I'm just looking 0.7% or so, but on these nuclear talks between US and Iran today. And we also have Russia-Ukraine talks as well today and tomorrow, with land being the key issue really around any sort of push towards some sort of peace negotiation slash agreement even. Yeah, watch the headlines for those two geopolitical events happening today and tomorrow as well. European equities, they are a little touch up actually, pretty flat to a touch higher after the cash market closed with losses of 0.1% on Monday in Europe. Just on those Ukraine talks, President Trump actually said on Friday that Ukrainian President Zelensky is going to have to get moving, and that Russia wants a deal. So yeah, that sets the stage for those talks today and tomorrow. First up, then, let's just also then look at earnings. And I want to show you quite incredible chart, really. This is Walmart's chart from back in 2021. So we've more than doubled since sort of where are we? Probably since July 2024, more than doubled. The stock rose 25% last year, so outperforming the S&P 500. That came in around 16% or so year to date, so outperformed that by double digits nearly. Doubled in around 18 months, the stock, and is up around, I think, 20% or so this year alone. It did hit a $1 trillion market cap in January. That's the 12th company to do so. And obviously, that means it's in the sort of exclusive club of big tech only stocks. Quite something for what is a supermarket essentially, but obviously it's moving away from that slightly as well now. They'll post their quarterly results, sorry, on Thursday before the US Open, and that is, or Walmart generally is regarded as a bellwether of the US consumer. So it will give us a glimpse into consumer spending, certainly in the wake of mixed signals from US data. We had retail sales recently were unexpectedly flat, potentially setting consumer spending on a slower path heading into and through this year. Though, of course, we did get a surprisingly strong headline print on the payrolls number, which we'll get into later, which did ease some concerns about economic weakening. Generally, though, it is a critical time for Walmart as it navigates domestic inflation pressures, strains on lower income US households, tariffs, of course, and also then its new AI strategy, which is sort of boosting its operational efficiencies, if you like. The stock really, or the company really, is sort of regarded as having a double threat. So it's got this now AI efficiency, operational efficiency, sorry, which is really spending billions of dollars on. And then it also has the threat of course, just the physical store infrastructure, and then its pricing power just through the sheer size of the company. President Trump's volatile trade policies, obviously, they will have weighed potentially on the company's operations and supply chain relationships with key growth markets, of course, in China, India, and Mexico. So that will be a key point for investors to look at, those supply chain relationships, really, and how they have been smoothed with some of these operational efficiencies as well. But generally, the company has performed very strongly. Revenue growth, actually, quarterly revenue growth has grown for nearly a decade straight. And as I said, well, we've hit the $1 trillion mark. That means record highs on a number of occasions. And yeah, it's up around 20% or so this year. Interesting, actually, it did shift as well to the tech-heavy Nasdaq index, having recently spent, as I said, billions on this e-commerce strategy, potentially to sort of rival Amazon. That's a big partner. So, in a way, the better it does, then it'll be interesting to see how Amazon responds. Of course, it's also partnered with OpenAI. This is Walmart and Google to integrate online shopping into their search chatbots. And really, then for the numbers, annual e-commerce sales are expected to hit $140 billion, and that's on annual revenues in total, topping $700 billion. EPS around 72 cents, I think, from sort of 62 cents previously. And then options markets, they see the stock moving plus or minus 5% after the release. So yeah, I mean the chart pretty self-explanatory. One way at the moment, overbought on several measures. This is the weekly chart. You can see on the monthly chart, very much overbought, 4 consecutive months of gains, and generally we have a very small dip before the stock moves higher again. That's on the monthly, and then the daily, you can just see we're way above the 50-day moving average at 118.14. You've probably got some very strong support around around here, 126, 127 or so. And then otherwise, record highs are at 134.65. So interesting bellwether, as I say, for US consumers, plus sort of a gauge really on its AI strategy, of course, with this divergence that we're getting now in the selling of tech stocks. Certainly will be interesting, really, how Walmart performs, of course, with its numbers, with tariffs as well, and then that sort of idea around consumers, US consumers, and also the K-shaped economy. So where the majority of consumers are more hard pressed than the more well off, the 20% or so who are enjoying wealth effects from record high stock markets and but still potentially shopping at places like Walmart, which are cheaper for some things, of course, and have a premium brand to it. But then the prices are pitched for the lower income households. This report actually does, I should say, precede other retailers as well in the US, so Home Depot, Lowe's, and Target. So just watch out for those. Will be interesting as that gauge, as I say, with or about US consumers. Just moving on from Walmart, then we do have, as I said, Europe's four largest mining companies: Rio Tinto, Glencore, Anglo American, and Antofagasta, also reporting all this week. That's at a time, of course, when some of the metals they mine have scaled new price peaks. So copper, gold, silver, other precious metals recently hit record highs, of course, but that relentless rally has, well, which was seen last month in January, has been more volatile this month, of course. The demand picture for those metals, very well known, of course. Data centers need copper, as does the grid infrastructure needed to build out the A or needed to power the AI build out. But then we do have US sort of political uncertainty, worries about the independence of the Fed Reserve, also propelling some of the precious metals, gold certainly, and to some extent silver higher. That surge has seen then the four companies' market value jump by more than $65 billion since the start of the year, and that is despite the abandoned merger between Glencore and Rio Tinto. So certainly group earnings could determine if this all continues or not. So just watch out for those miners. Will be interesting, and also what they say about some of the precious metals and copper. Okay, moving away from that, then just equities generally. If I just pull up a few charts here, first up, just the S&P here, and equities really, well, they remain largely unchanged on Friday. Obviously, US was closed yesterday. That concluded a mild risk-off week last week, really driven by macroeconomic developments. Or sorry, not really by macro developments, really. It was all about concerns about AI disruption. So if we just go back a step on this, really important this because of this theme really, which has been growing in importance in the last few weeks, really. So what began in software this year, obviously that big sell-off in software that we got last week, that extended to various other sectors like logistics, like transportation and wealth management. Basically, as investors reassess the disruptive potential of AI in high margin service businesses. We got those releases of new Claude and other bots as well. And they really sort of put the frighteners on some of these, yeah, high margin service businesses like wealth management, like logistics. Logistics was a crazy one. It was basically a karaoke company, can you believe, who then switched to or suggested a new AI processing model, essentially booking model, and that sparked big moves in logistics companies. Some of these huge global logistics companies down double digits on the back of a company which I think was worth $6 million only, and I think it doubled pretty quickly after that. But Friday, that really saw, yeah, investors cautious about software, although they did return to software on Friday, but very cautiously, and it wasn't really a significant rebound. with the industry gaining around 2%, I think. But it was one of the better performers on the day, the sectors. Is that a sign of selling pressures in tech subsiding? There is really considerable catch-up potential to be made in some of these cyclical stocks. Macroeconomic conditions have simply been stronger than markets have priced this year, but then utilities, real estate they've risen 5 to 6% only in the past week or so, while consumer staples have surged 10% in the past month. Healthcare, that's up almost 20% in the past 6 months, but that sort of defensive comeback possibly seems premature as it's not really supported by a weakening macro backdrop. And that's the issue here. Instead, they're sort of defensive, sort of halo sectors, if you like, that have provided refuge for investors, which now are kind of selling and then not asking questions till later, if any time. Those are sort of market dynamics we've seen in the last week or so. Of course, when the focus does shift back to fundamentals, cyclicals will catch up then, but then near term, despite that modest recovery in software that we said on Friday, that session actually on Friday was largely still defensive. So healthcare, real estate, utilities, all the top performing sectors, while banks and big tech lagged. Small cap stocks, they outperformed globally with the Russell 2000 doing very well this year and recently. So yeah, just some thoughts really on that sort of AI disruption trade, where it goes next potentially or not, and whether, as we've seen a little bit of buying in the software sector, then that will be something to monitor going forward as to whether that AI disruption trade does sort of ease off slightly. For the broader index, you can just see we've struggled around 7,000. So that really is a huge psychological level as well as a big resistance level. We're just back now at the grey line, which is the 100-day moving average. That's at 68.12. This is on the S&P 500. And then a 50-day just above that, 68.94. And then obviously 7,000 around that being a big, big barrier. Below that support, then you've got a minor fib level at 66.98. That's on the S&P 500. If we go to the NASDAQ, struggling, of course, haven't really hit those heights above 26,000 for some time now. We're below the 100-day and below the 50-day. You can see that at 25,233, 25,420. We're below that minor fib level at 28,4867. So next would be this major fib level, which capped the downside here in November. That's at just above 24,000 with the 200-day moving average below that at 23,884. Dow tap 50,000, of course, 50,000 and 500 more or less, but we backed off from that. We're still in this sort of ascending channel, if you like, which I've kept on there. So the low in that channel would be around that 50-day moving average, the blue line, actually, interestingly. So that's at 48,863. If we break down through that, then probably we've still got some support around here, around the 48,500 mark. Otherwise, in the 100 days below that, 47,829. And then the first major fib level for us, which I've drawn from there, would be, you probably shorten that up, but 47,221. So interesting whether these old economy stocks, if you like, more defensive stocks, whether they continue to outperform or not. Okay, that's sort of equities and earnings. I did have kept these charts in here that we've seen before, but just to highlight that sort of software issue against the hardware issue. The blue line being hardware, semiconductors really versus the software black line, which has been tanking, of course. And then you've got the lag 7 against the wider indices as well, which we've highlighted for some time now and is continuing to continue to happen. Okay, moving on from that, let's get to last week's main event. So first up, we had the jobs report, of course, on Wednesday. Slightly odd for those of you who have followed the markets, of course. For us, it was a little bit odd being on the Wednesday. Anyway, interesting report the headline, of course, that blew past some of the most optimistic estimates and ended actually a sequence of disappointing data since last week, actually, which we highlighted. So the headline print 130,000. Double the expected 65,000, negatively skewed by continued job cuts at the government level, 42,000 jobs there. But a big but here, and we highlighted it in our daily commentary actually, but there were signs of labour market fragility. So January employment almost exclusively driven by the education and healthcare sectors. They contributed 137 of the 130 jobs, obviously given that government lost 42,000 jobs, but combined with an unexpected drop in the unemployment rate, 4.3%, even as participation rose. It all sort of wrong-footed the market and pushed back the next Fed rate cut to July from June. As I say, the details though weren't great, and we've highlighted before around the concentration in just a handful of, or less than a handful of sectors, which aren't really strong sectors to keep the economy growing. We also had benchmark revisions, of course, annual benchmark revisions. These provisionally they were estimated to be around 911,000 coming off the figures, so that's 76,000 per month. Chair Powell, he said that they would probably be around 60,000 per month, 720 for the year. They were actually down in the middle, actually 862,000. A key point here really is that this wipes out all the job gains in sectors that aren't government, leisure and hospitality, and private education and healthcare services over the past 3 years. So that means the likes of retail, if you think about it, construction, manufacturing, technology, financial services, and business services are all failing to generate employment. And that is what we've been talking about for quite a few months now. That means the annual revision resulted in average monthly job growth last year of just 15,000 instead of the initial 49,000 which had been recorded. That's 181,000 for the whole year, and is actually one of the worst years for job additions since 2020. Interesting numbers, sort of mixed report, and that's why we didn't get a big jump in the dollar. Why really we saw yields collapse. Actually, Treasury yields turn much lower quite sharply. All increases the political pressure on the Fed to cut rates further, and yeah, the sort of headline numbers mask and disguise really what we're seeing underneath, under the hood, with the differences between these sectors. That is slightly outdated, actually. This is before then. Apologies for that. This was the preview, actually. It was a coin toss for a 50 basis point, sorry, coin toss for a 25 basis point cut in April. First move priced in June. That was pushed out after these numbers to July, but then we still had two rate cuts for the whole of the year. And that, in fact, actually more around 56, 57 basis points for the whole year. That has changed further actually since we've had those numbers. But for the dollar, as I said, interesting. Should have rebounded on those jobs data if you look at it as a headline, and those prints for the headline. But a lot of the move higher was pulled back, reined in. And yeah, the details were looked at and a viewpoint taken there. It kind of means for the dollar, just touching on that, then the bar for a dollar recovery is higher. Really, we need more good data, really, because that sort of mid-January sell America phase that we saw is having lasting damage on the greenback, like actually in summer 2025. Just more charts. That was the original forecast, 70,000. We got sort of close to double that. And actually the highest number print, I think, since yeah, April of last year then. And moving on then to US CPI data, that's the job data really, but the CPI data, the headline prices, We saw this data on Friday. They rose by 0.2% month on month. The core up 0.3% month on month. That means the annual number slowed from 2.7 to 2.4 and core down to 2.5 from 2.6. Importantly, core services, that's ex housing, that increased by 0.56% month on month. That's the biggest increase in a year. In yearly terms, annual terms, that closely watched indicator, because it's basically domestic inflation, but so closely watched by the Fed, that fell actually to the lowest since 2021. But if you, well, a more dynamic annualized number based on the 3 month moving average marched to then the highest since April 2024. So sort of semantics really on different data points there. Markets ignored that detail really. And actually Atlanta Fed's Goolsbee raised the issue actually later last Friday evening, saying that high services inflation is worrisome, and he feels really we're not on the path back to 2% just yet, but we're stuck around 3%, and he wants to see progress before backing a front loading of rate cuts. Just for your guide, energy prices, they fell 1.5% month on month, while used vehicle prices dropped 1.8%. Virtually all other components pretty well behaved actually, with housing costs rising just 0.2%. So after the data, US 2-year yield actually closed below key support of 3.4%, while the 10-year yield lost minor support at 4.1% to end at its lowest level since the end of November. Uh, and near-term Fed rate cuts, they remain still very low, around sort of 30% for April, but investors became more confident in the path towards 3% by year end. And that's probably what's key and what we've seen in these moves in treasuries. I want to show you these charts actually, because we don't look at them too much, but just to show you the importance of some of these levels. This is the 2-year, and you can just see, I'll show you 2-year. This is a 2-year treasury yield basically. So this tracks the Fed funds rate very closely, if you're looking at treasury yields. And you can just see we've dipped lower through sort of this previous spike low from Liberation Day, actually April last year. That was around 3.44. We're now down to 3.4. So we've still got this low from October at 3.37. So interesting chart here, because if we lose that, there's not much there until we get down to some of these levels here from August 2022. So interesting level in the 2-year, naturally following Fed funds really, or Fed funds following this really. So whether we stay down here or not will be interesting. If I just show you the 10-year, which is here, you can just see how we've lost. Yeah, this is a 10-year, 4.1%. As I said, 4.17%, and we're now down near close to 4%. And some of these big levels down here from October of last year, around sort of 3.94%, and just above there. So interesting levels in treasury yields as we dip. And then, as I said, rate cut bets for sort of near months, March, April, pretty low still, 30% chance of a cut in April. But then as we push out through the year, we get around 58 basis points, I think now. That 50 sort of 6 was post non-farm payroll, but now we're pushing towards 60 basis points. So that is a sort of two 25 basis point rate cuts, of course, and then a sort of 40% chance of a third rate cut by the end of the year. Okay, those are the treasury yields. Let's just check. Actually, let's have a look at the dollar as well. You can just see, interesting, because treasury yields would normally, lower treasury yields would drag on the dollar. We've sort of steadied really, and we're still in this sort of area of that long-term trend line from the 2011, 2021 lows. That comes in around where we're currently trading, really, 97.24 or so. You've got the 200-day at 98.47, and then the 50-day above at 98.04. Otherwise, long-term low, 96.21. with that very brief low from January at 95.85. That is the dollar index. Okay, let's move on to this week's main events. And we've had some UK data already. But we do have inflation as well. Actually, yeah, last week we did have GDP out of UK as well. That saw growth grow by 0.1% Q on Q in Q4. That missed expectations of 0.2%. Really uncertainty around the November budget that weighed on activity. Business investment that fell by nearly 3%, reflecting sort of hesitancy amid those sort of economic and political challenges. Manufacturing basically drove growth with the sales service sector stagnating and construction contracted. But obviously, all focus now on this week's data. We've had it's the middle of the month, so we get a data dump, if you like, is what we call it, from the UK. We had today's monthly labour market data. Very briefly, that showed a further moderation in wage growth, softer than expected employment growth from Q3 to Q4, and January payrolls pointing all to a weakening labour market. Unemployment rate that rose to 5.2% at the end of last year, and that is now only just below the post-pandemic peak of 5.3%. All those numbers really add to the March Bank of England rate cut bets, following, if you remember, a close call, 5 versus 4 to hold rates unchanged in February. Um, More hawkish members often referred more evidence of wage moderation as an important factor to switch sides. So that's what we're getting, and this will be of interest to the MPC and the Bank of England for their next meeting in March. Otherwise, a lot of attention will be on tomorrow's inflation data. The reading, actually, the headline that rose to 3.4% in December, down from a peak, of course, of over 11% that you can see on this chart in 2022. But still the highest in the group of 7 economies. Consensus predicts the headline rate at 3% now from 3.4%. That's the orange line. And the core should also print at 3% from 3.2%. That's that light blue line. And then the all important services should dip as well from 4.5 here down to 4.3%. Crucially, as well, the Bank of England, so we're falling, of course, in this print, but the Bank of England sees the inflation outlook lower in the next 6 months, primarily due to softer energy prices. The big decline is predicted in April when those lower energy prices come into effect in that month, and that should help then drag inflation much closer to the Bank of England's 2% target. Some thinking actually it'll hit 1.8%. Although much of that slowdown again is due to one-off factors, and we could drift possibly a touch above then through the following months. Certainly, though, all impacts the Bank of England and that March meeting. As I said, there's around 20 basis points priced in, probably more now, actually, post the employment data, and sort of 27, 28, 29, 30 basis points in April now. Of course, the language, just to reiterate from the recent Bank of England statement, has been balanced, but did keep the focus on the medium term. That 5-4 split, as I said, Bailey is basically key. He's always the tie break. And on inflation, the governor has said he expects to see quite a sharp drop in inflation over the coming months. Yeah, bear that in mind, of course, as we get these numbers. And then also, just as an aside, separately from the macro sort of picture, we have had that political turmoil recently, and a sort of interesting backdrop for sterling and gilts. And that will rear its head again when we get this by-election at the end of February. And then, of course, then we get local elections in May in the UK. Really, really big deal for potentially PM Starmer and whether he actually has to step down. I know betting markets are a sort of coin flip, I think, as to whether he steps down by June. Um, So yeah, that is just a backdrop to, of course, all this data and the Bank of England decision in March. Let's pull up sterling now, just to show you cable first of all, which is here. And you can just see that high at 138.68, and we're just off that now. We're down to the 38.2, potentially at 135.40. You can see sterling underperforming after those weaker than expected labour market data points and the chances, increasing chances of a March rate cut by the Bank of England. You've got the 50-day moving average at 135.14, and you've got the halfway point of this move higher. That's at around where the 200-day moving average is, actually around 134.36. And then below that, you've got the next fib level, 133.58 or so, which is a 61.8 fib level of this move from the November lows up to the January highs there, in amongst the bigger move there. So that's cable. We can probably get sterling weakness as well shown in euro sterling. You can see it here. We're just pushed above the 50-day moving average at 86.99. You've got the 100-day moving average at 87, sorry, 24, minor fib level 87.18. If we get beyond this, then we're up to sort of 88, and then 88.65 is that recent high from November of last year. Okay, moving on then, we also have PMI data, which is, as I said, global surveys of business activity, basically, which in January showed a pickup in most major economies. Actually, services are gathering momentum as price pressures continue to subside, really, while manufacturing a little bit more of a drag. Surveys don't really just tell us actually what has happened, but also you get sub indexes on new orders, employment, and pricing, which all give a sense of how companies are preparing for the months ahead. Lots of questions hanging over longer term job security, of course, and company bottom lines from the rollout of AI right now. But investors will probably scour these figures with closer interest than normal just because of all those other factors going on. You can just see here blue means numbers above 50, so expansion. Red means numbers below 50, so contraction. Um, if I just pull up euro dollar then as well, services meant to be fairly strong above 50, manufacturing still lagging, as I say. Let's just pull up euro dollar. Obviously, this is being moved around by various factors really. So you've got the high for recent high at 120.82, then that previous high from September of last year, 119.18, just rolling over then support at the 50-day moving average at 118.13, and then below that you've got the 100-day at 116.86 and the 200-day at 116.37. We do get, as I said, central bank meeting in the RBNZ. Just pull up the Kiwi dollar chart here, which has done well, of course, in line with the Aussie as well. Um, just on the RBNZ, the bank will leave the OCR, the overnight cash rate, on hold at 2.25%. It's the first meeting actually with Anna Brayman in charge. She took up her position on the 1st of December, actually. Yeah, position as governor, of course. At its previous meeting in November, the RBNZ, they cut rates by 25 basis points. That was its third straight cut, actually bringing cumulative easing to 325 basis points since it began its rate cutting cycle in August 2024. But the bank did leave the door open to further moves, saying future changes to the OCR would depend on how the outlook for medium-term inflation and the economy evolves, although its projections implied a pause through 2026. We do get fresh interest rate projections, and potentially they're likely to be pulled forward, signaling the chance of an OCR hike beginning December of this year versus the prior early next year sort of hike move. That is what markets are expecting, actually. So, will be interesting because Bremen hasn't really signaled that sort of more hawkish stance just yet. Um, Stronger economy, of course, elevated inflation likely to be acknowledged, but ongoing excess capacity and tighter financial conditions potentially should offset this and mean steady rates for some time. So it's just the level of hawkishness, really, that the new governor portrays, expectations that it will be fairly significant, and then this bringing forward of the first rate hike to the end of this year. Whether if those obviously those expectations are missed, then certainly that will hit the Kiwi, which, as I say, has done very well this year. You can see that jump up from sort of above 57 up to that high of 60.92, not quite as high as the 61.20 from July of last year. So we're just oscillating around here, bullish consolidation potentially, but we do need to beat that 60.92, of course, and then the 61.20 for it to get higher. Otherwise, yeah, you've probably got support around that minor fib level, which is at 59.70 or so. And then you've got well, interesting, the 50-day just moving above the 200-day. That is bullish generally, golden cross essentially. So that's for your guide. The 50-day and the 200-day around 58.72, which corresponds with that minor fib level at 58.77 as well. Okay, I will wrap it up there. Thank you so much for being with us. Really do appreciate it as always. We will be back same time on Monday. So apologies for that slight delay in this. Please do follow us on social media and also our daily commentary on the website after the US close. Take care out there, and we will speak to you very soon.